So Terence, in the last 2-3 decades, the EU and the OECD have been trying to create a level playing field by forcing the exchange of information and by fighting preferential tax regimes. Now with Pillar 2, they're intensifying this fight with the introduction of a global minimum tax. What can you tell us about the impact of this Pillar 2 around the world?
So Pillar 2 is another OECD initiative, and it's expected to impact a fairly large group of multinationals. It basically consists of a series of interlocking rules that allow countries to impose a top-up tax on low tax income of these multinationals in their countries. So basically, what they want to achieve is they want to make sure that these multinationals pay at least 15% in taxes in every single jurisdiction that they operate in. The expected impact of Pillar 2 is substantial, to say the least, because according to OECD estimates, around 36% of the profit of these multinationals that are in scope is expected to be low tax, so tax underneath below the 15% rate. And implementing these rules is expected to generate yearly tax revenues ranging between $150 and $192 billion, so that's a lot. And 2/3 of that amount is actually attributable to the Pillar 2 legislation directly, while 1/3 is a result of restructuring and reorganizing of these multinationals and shifting their operations due to these rules as well. So it's definitely something to keep an eye out for.
So now that we know a little bit about this Pillar 2, can you tell us also something, how does it actually work?
Well, to put it briefly, imagine you have a multinational that has a subsidiary in a jurisdiction that has no corporate income tax system in place, right? So they are paying 0% in taxes. In that case, we'll say from a Pillar 2 perspective that their effective tax rate in that jurisdiction is 0. And of course, they want to achieve the minimum rate of 15%. So they will be levying a top-up tax of 15% to bring that rate up to 15, right? The question really is, how do they get to collect that 15%? Now, firstly, this low tax jurisdiction that we're talking about has a possibility to introduce a qualifying domestic minimum top-up tax, what we call the QDMTT, in order to collect that 15% in taxes themselves. If they do not do so, then you'll basically be looking at the direct or indirect shareholders of this low tax subsidiary and to assess whether these jurisdictions, these countries have implemented the so-called income inclusion rule, the IIR, which would enable them to collect the 15% instead. If that's not the case, then we also have a backstop rule, the UTPR, which basically would enable all other jurisdictions where this multinational is operational to collect the 15% if no QDMTT or IIR has been fully applied. So what you see is that through a combination of all these rules, these multinationals will be paying 15% in top-up taxes, in this particular case, at least in one jurisdiction or another.
Now that we know about the QDMTT, the IIR and the backstop rule, what can you tell us about the multinationals that will actually be covered by the Pillar 2 rules, and by when should they be ready?
Right, so first of all, we have to be dealing with a multinational. That means that we're talking about taxpayers with constituent entities in at least 2 jurisdictions or more. Right? Secondly, you would have to take a look at their consolidated worldwide turnover, and if it exceeds 750 million euros, then they would basically be in scope of Pillar 2. Technically, though, you have to look back for 4 years and take a closer look at the consolidated group turnover during those past 4 years, and if 2 or more of those 4 years the consolidated group turnover was more than 750 million euro threshold, then this multinational would know that for the year ahead, it automatically falls in scope of Pillar 2. And you know, these rules are actually already here. A lot of EU jurisdictions have already implemented them, including the Netherlands, Germany, Belgium, and Luxembourg, just to name a few. But also jurisdictions outside of the EU have implemented these rules, such as UK, for example. And according to OECD estimates, by 2025, over 50 jurisdictions have implemented these rules. That means that around 80 to 90% of all multinationals that meet that 750 million threshold that I was talking about, that they would be dealing with Pillar 2 in one way or the other, in one country or the other. However, USA, for example, is not expected to implement these Pillar 2 rules at this moment. Of course, that doesn't mean that multinationals headquartered in USA with operations in other jurisdictions that do implement these rules don't be affected by these Pillar 2 rules as well, right?
So we have a lot of multinationals from outside the region that are covered by Pillar 2, and they have operations across the region in the Caribbean. And of course, we also have Caribbean multinationals that have the 750 million euros in revenues. Are the governments in the Caribbean ready for Pillar 2?
Well, you see that a lot of jurisdictions in the Caribbean and in the region obviously have been looking into these Pillar 2 developments and have been assessing how best to deal with them and how to outline their own Pillar 2 policy themselves. You see, for example, Barbados has already, they are increasing their corporate income tax rate to 9%, while they also introduce a QDMTT. So they really want to make sure that if there's any low tax income being generated in Barbados, that is actually taxed up there in Barbados. You see other jurisdictions actually closer to home, like BES, where the Pillar 2 rules are also applicable, except for the UTPR. You see other jurisdictions that previously did not have a corporate income tax system, like Bermuda, for example, and they are contemplating or they're introducing a 15% tax rate for certain taxpayers. So it's not necessarily a QDMTT, but they are collecting some taxes themselves. You see that jurisdictions are really looking into how do I determine the best Pillar 2 policy for my jurisdiction, and how do I best protect my tax base as well.
We know that almost all countries in the world should be dealing with Pillar 2, as these rules apply across the world. The multinationals that are covered by Pillar 2, what should they be doing at this very moment to prepare?
Right, so there's a lot that these multinationals can do and quite frankly should already be doing. One example is, for example, to perform modeling exercises. These modeling exercises will help these multinationals realize where they have low tax jurisdictions for Pillar 2 purposes and also estimate their top-up tax liabilities in these jurisdictions. So that's really insightful. Additionally, it will also help them realize how much data they will be required to gather in order to perform these Pillar 2 calculations, all these filing requirements, because that's also really significant. And that really brings us to the point regarding tax compliance, because the tax compliance burden that this will bring is also very impactful. So these multinationals have to make sure that they have the right team to help them deal with this and the right resources. So that's also very important. And additionally, they want to take a closer look at their CBCR, their country-by-country filings, as they will be looking to qualify for the so-called CBCR Transitional Safe Harbor Rule. So that's also another point of attention. And lastly, I can mention, for example, that the accountants, the role of the accountants is also important in this respect, as they will be looking into when and what do I have to disclose in connection with these Pillar 2 developments. So that's just a couple of things that they should consider, and there's a lot that they should consider though, and it's a very significant and impactful change, and they have to be sure that they are ready and start dealing with this as soon as possible if they already haven't.